forward to working with you.
Senator
Thank you.
Scott.
Thank you, Mr. Chairman. Thank you, Mr. Cordray, for being here this morning. You made a speech to the credit unions and talked about how the mortgage market was good for all, the good news for all around, that more opportunity for more consumers and a wider path to the American dream, and a mortgage market made stronger by the changes we have made. But the evidence for first-time homeowners over the last 3 years is that the first-time homeowners have been in decline, and that disproportionately impacts minority would-be homeowners, since the fact of the matter is that about 75% of majority population owns homes, about 45% of African Americans own homes, about 55% of Hispanics own homes. So my question really is, when you look at the rules and Dodd-Frank being put in place, how do we reconcile the mortgage market specifically is good news for all around, when in fact for first-time home buyers who are a disproportionate minority, the news is nearly as good. But what we have seen throughout the country, and specifically at home in South Carolina, is that the rental market is far more expensive, and the growth, really an explosion in apartments, is nearing an all-time high in the last decade or so.
Mm-hmm. Yeah, so this is, I know you raised that issue on Tuesday. I had a chance to review the transcript of the hearing, and it's an important and it's an actually very interesting issue, a lot of pieces to it. So first of all, I would say, in terms of first-time home buyers, I think if you look at the statistics on the mortgage market, what you will find is that of owner-occupied real estate, first-time home buyers are still maintaining about the same share that they have. The difference that's affecting the market is that there's many more investor-owned and investor-purchased properties than there had been before the crisis. It appears that investors have seen their opportunity as prices plummeted, and they have bought up a lot of properties. And this is going to be a problem in a number of communities, because although it helped find a bottom in certain markets and maybe create equilibrium, it has pulled inventory off the market and made it unavailable to, say, you and me, if we were going to go try to buy a house tomorrow. There are also inventory problems in local markets around the country. Sometimes many houses are tied up in the foreclosure process, depending on the state. Sometimes many houses remain underwater, depending on local valuation, so it's difficult for someone to sell if they're underwater on their mortgage. So, and home builders have been kind of reluctant to come back in with a rush to the market and build new inventory, although that's starting to happen. So, by the way, I don't want to be viewed as some sort of happy talker who sees a glass half full if there's just a few drops in it. But what I do see in the mortgage market is that the share of the mortgage market that is taken right now by credit unions and community banks together has risen since Dodd-Frank, has risen since our rules took effect, and is at levels that are the highest they've been in 20 years. That's a good thing. Those institutions did do the best lending right through the crisis. When everybody else was deteriorating, they stayed firm. They had low default rates, and we have tailored our rules to give them advantages and recognize their model in the mortgage market. And I think that's a good thing.
It certainly appears to me that the consolidation within the banking space has led to more access and opportunities for smaller credit unions to continue to grow. And
I think so. Frankly,
in Section 1022 of Dodd-Frank, it states plainly that the Bureau, by rule, may conditionally or unconditionally exempt any class or covered persons, service providers, or consumer financial products or services from any provision of this title or from any rule issued under this title. Do you think if credit unions or community banks were being detrimentally impacted, we've talked about the mortgage market specifically, but generically speaking, by the rules of your agency, this section would allow there to be more tailoring of regulations? Do you see that as a possibility that you're going to take hold of, or do you see the need of it or not?
We have been doing that since the beginning, and we tailored our mortgage rules in particular, which of course is the most significant finance market for all players at around $10 trillion. We tailored our rules in notable ways for smaller providers, and we continue to do that. We've just implemented Congress's, I thought, helpful legislation on definition of rural in a way that was very broad for smaller institutions. What I will say about the exemption authority is we tend to be fairly careful about it. We don't regard Congress as having said to us, you have broad exemption authority. You can do whatever you want despite what Congress said. That would be too much. But where we have evidence that we think we can build on in particular rulemaking, such as the mortgage origination rules, the mortgage servicing rules, the remittance rules, we will tailor for smaller institutions because very often that's the right answer. They're responsible, they're close to their customers, they provide good service. But the notion that we would simply countermand, I mean, Congress set its own limits here in terms of we have authority over banks over 10 billion, but not under, in terms of supervising them and the like. Congress didn't just exempt credit unions from all laws and regulations, and therefore I don't feel that I can just come in as a matter of opinion or ideology and overrule that. But where I can see that, say in mortgage rules in the mortgage market, they've done well, and we should try to tailor our rules accordingly. We have done that. We will continue to do that. And I'd be glad to take your and your colleagues' input on how you think we should be doing that. And we get that input directly from ICBA, from NAFQ, from CUNA all the time.
Happy to have that conversation with you offline if you're
Sure.
open to it. And my main concern as I wrap up, Mr. Chairman,
Thank you.
yes, sir, is that when you look at the number of households that are unbanked or underbanked, I know that we talked last on Tuesday about 1 million households.
Yes.
The fact of the matter is that with better information provided by staff, the number is around 4 million under and unbanked households because the more the regulatory burden impacts the institutions, the higher the cost, the lower the access. And part of the unintended consequences, I assume unintended, is the fact of the matter that 4.4 million households are now either unbanked or underbanked than was at the beginning of Dodd-Frank.
Yeah, well, actually, I'd be interested in knowing exactly what the numbers and the dates are, because since the crisis, certainly that number has gone up because the crisis blew up the economy for people. Whether it can actually be pinned on Dodd-Frank, when we didn't even open our doors till July of 2011, that's where I would get off the train on some of the commentary I've seen on this.
Happy, one of the things that we did was make sure that the numbers that we used didn't start in 2008, immediately after the crisis.
Yeah, that's 3 years before
Exactly.
we came along.
That's why we didn't use it.
But by the way, I think we certainly,
that
I know we would
conversation.
agree that the fact that credit unions reached an all-time high in membership nationally last year is a good thing. I'm very supportive of that. I'm sure you are too. But again, it's notable that if our rules are supposedly killing the credit unions, how is their membership now at an all-time high? Doesn't really
There's no doubt
square,
that
does
the
it?
number of members at credit unions are higher. The number of credit unions themselves are lower. So the
Yeah,
fact of
although
the
that's
matter is that
been a
the
decline that's been steady for
contraction of
30
credit
years.
unions and banks obviously are happening, and there's a consequence that comes with regulations that may be contributing to that fact as well.
Maybe, although that's been a consistent trend for 30 years, and the evidence I've seen is that it hasn't accelerated since Dodd-Frank, although there was a Lux Green study that I think is, in my view, discredited that seems to suggest that. I don't think it bears out when you do the analysis more carefully.
Happy to continue the debate.
All right,
Thank
sure.
you.
Thank you.
Senator